Hey, what's up, my friend? So, in today's video, I want to share with you four things that traders learn too late. Okay? So, since you're watching this video, then hey, it's not too late for you, right? But often, right, when I see traders who blow up their account, traders who quit trading altogether, it's because they don't realize, one of these four lessons that I'm about to share with you. Okay, so let's get started. First lesson is this, right? Imagine you own a fried chicken business. You have a business that specializes in selling fried chicken. Let me ask you, what is the most important thing for you right now as a fried chicken business owner? I'm sure you would agree that the most important thing right now is to make money, to be net profitable, right? So you would focus on your net profit. You want to make sure that your revenue less your expense, right, is a positive sign. This means you're making money consistently, right? You make money in the long run if your revenue is always larger than your expense. And you won't be focusing on stuff like website, domain name, legal stuff, branding, logo, and stuff like that. Yes, it matters, but right now, the most important thing is net profit. And how do you get net profit? Well, you work on getting more customers, right? The more customers that comes in, the more customers that buys fried chicken, the more money you'll make. And the greater your net profit. Simple stuff, right? And why am I sharing this with you? Well, because this concept here is the same as trading. As a trader, right now, right, if you are not profitable, you're break-even or you're losing trader, the most important thing right now is to find an edge in the markets, to have a trading system that has an edge in the markets. Right? It's not to focus on your risk-reward ratio, your trade management, your psychology, your discipline. No, none of that. Yes, those matters, but not till you find an edge in the markets. Not till you have a trading system that has an edge in the markets. Once you have an edge in the markets, then fair enough, you can work on your trading psychology, you can optimize maybe your risk profile, you can better time your entry, you can work on your trade management and stuff like that. But not till you find an edge in the markets. And it's the same for the fried chicken, right? Once you have a fried chicken business that is profitable, maybe you can take some of the capital and invest in marketing. You can work on your branding, you can work on your website, your domain and stuff like that. But not till your fried chicken business is profitable. Okay? Make sense? Good. Then let's move on. And by the way, if this is the first time you're watching this video, right, give me a thumbs up button, ding, 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 right, and subscribe to my YouTube channel. The button is just below, just click subscribe. This way, whenever I publish another video, maybe another fried chicken video, okay, you will always be updated. Good? Okay, let's get started. Number 2, you must have the right expectations in trading. So often, traders come into this business and they have unrealistic expectations, right? Maybe it's from the marketing, the advertisement, right? They think that they can take a few $1,000s and trade full time, take that few $1,000s and turn it into 6 figures or 7 figures within a short period of time. Well, I'm here to tell you that those are unrealistic expectations. And the problem with unrealistic expectations is it dampers your learning curve. For example, let's say you have the expectation of making 50% a month, maybe because that's what you've seen other traders do, okay? And let's say, you are trading a trading strategy and that month you only make like 3%. And you think to yourself, man, I'm 47% away from my target. Let me ask you, what would you do to reach that target of 50% a month? Chances are you're going to increase your risk, right? Because you have a target of 50%. You're only up 3%. A measly 3%, which is pretty decent, but you think it's only a measly 3%. So you take in more risk and then you hope the larger risk that you take, right, could get you to your 50% target. You might get lucky. First month, second month, you might hit your 50% target. But in the long run, eventually the drawdown would come. And then you, boom, right, bust your trading account. And that's how traders go bust. Because they take on too much risk relative to their account. Because they have unrealistic expectations. That's number 1. Number 2, you might have, a profitable trading system. But again, right, you make a measly return and you think that, man, this system isn't working. Let me look for something else, something better, something that can make me more money. All right, then you hop onto another trading system. Might work out for a while, then again you realize, man, it's not what you're looking for. Then you abandon it and look for something else. And in the long run, what's going to happen is that you will hop from one system to the next, to the next, to the next, to the next, and realize that you're going around in circles, getting nowhere, frustrated, give up, boom, you leave the trading industry altogether. And that's what is likely to happen as well. So again, right, have realistic expectations, right? If you ask me, right, if you trade off the daily time frame, you can benchmark anywhere between 10 to 20% by risking 0.5 and 1% risk on each trade. This is just a very general ballpark figure, okay? If you're better, you can do better than what I just shared with you. And perhaps if you're a lower time frame trader, swing trader or day trader, you can also expect a higher percentage return, a higher R multiple, right, for the full year because you have more trading opportunities. So this is just a very general ballpark figure for you to expect of, right? And don't worry if you have made this unrealistic expectations before, right? Because I myself, I did the same thing. When I just graduated from university, I thought that, hey, I can pull some money like about $20,000, right? And to trade full time, right? All I need to do is just make 20% a month. That's $4,000 a month, and I can pretty much, live comfortably. So I tried it for a few months and I realized, man, this is not working out. And that's why I abandoned, right, that so-called full-time trading career that I had for myself, right? So that's where I got into a job at an MNC before getting into prop trading, before got into TWR, and that's a story for another day. But again, I made the mistake just to share with you as well, right? So have realistic expectations. Next, not all returns are created equal. So let me ask you, or rather you can see for yourself, right? There are two systems over here, System A and System B. So System A, right, gives you 100% return. Woo, 100%. And System B gives you a net return of about 30% a year. Let me ask you, which system do you prefer? System A or System B? I know most of you are thinking, man, this is a trick question. Yeah, you're right. It's a trick question because I didn't give you the full details of it, right? Because what I failed to tell you is what is the risk required, right, to trade these systems. So let's say, for example, System A has a 100% return a year. But what I didn't tell you is that System A now, right? I know most of you, of course, Rayner, System A, right? So simple, right? The highest return, best system. Yeah, go with this. But what I didn't tell you is that, System A, let's say it has a drawdown of 80%. Means at one point in time, right, it has an 80% drawdown. So what this means is that if, let's say, you have a starting capital of $1,000, if you trade System A, right, there's a possibility, right, the system, right, would cause you to lose your capital, losing 80% of your capital from 1,000 down to $200. So that is a loss of 80%. So that is an 80% drawdown. Whereas on the other hand, System B, right, let's say a 30% return, and the maximum drawdown is, let's say, 10%. So again, you have $1,000, and the worst that the system would perform, right, is a maximum drawdown of 10%. So you can expect that $1,000 to decline possibly to $900. So you can see that clearly, yes, System A, it has greater return, but at the same time, it has a greater level of risk required to trade it. So what I'm trying to bring across is that you must know the risk required to achieve the returns. So don't see, social media, website, blogs, and people boasting their returns, because it may be a very high return, it may be very good, but what they don't tell you or show you is the risk required to achieve those level of returns. And that is important, my friend. So one way to kind of, quantify or judge how good a trading system is you can look at something called the MAR ratio, the managed accounting reporting ratio. I hope I got this right, because this is a term derived from the hedge fund industry, right? The MAR ratio. I might have got it wrong, but anyway, the way to calculate this MAR ratio, MAR ratio, is to just simply take the annual return divided by the maximum drawdown. So for example, the first one, right, let's say annual return 100%, maximum drawdown is 80, so that should get you about 1.25, is it? Man, I'm good. 1.25, okay? So your MAR ratio is 1.25. For System B, you just take 30, let's say is the annual return divided by 10, that's the maximum drawdown, and you have a MAR ratio of 3. So clearly, right, from a risk to return profile, System B is a better trading system. Because for 1 unit of risk, right, it can offer you, right, 3 times the return for 1 unit of risk. A way to look at it is, what I pretty much said. For 1 unit of risk that you take, it offers you 3 times the return. Whereas for this, right, for 1 unit of risk that you take, it only gives you 1.25 return. I mean, in the real world, this is actually pretty decent already, but I'm just, putting things in perspective here, comparing System A and System B. So one way to judge the performance of a system, right, not just looking at the net profit, is to look at the MAR ratio, right, which is annual return divided by the maximum drawdown, and you get the MAR ratio. Next, not all trading strategies are created equal. So this is quite interesting. So let me just share with you. Let's say let's talk about trend following. So trend following is a trading system, a trading strategy, right, that seeks to ride trends in the market. the win rate are typically low because, most of the time the markets don't trend, hit your stop loss and you get a loss. So let's say, for example, a trend following system with a 40% win rate and an average of a 1 to 2 risk reward ratio. Okay, let's say out of 10 trades, you have 6 losers and 4 winners. So clearly you can see that at the end of it, right, let's say, 1% risk to keep things simple, right? You would have, 6 losers minus 1%, minus 6%, 4 times 2, right? Because as an average risk to reward of 1 to 2, so you get a net gain of 2%. Okay, so this is for a trend following system. 6 losers, 4 winners. For mean reversion system, right, it tends to have a higher win rate. Okay, let's say you have a win rate of 60%. And poor risk to reward ratio. I won't use the word poor, it's not really a good word, but let's say it has a risk to reward ratio of about 1 to 1. So okay, this one is quite straightforward. Let's say you have 6 winners and 4 losers. Your net gain is also 2%. Why 2%? Very simple, right? The 6 wins that you have, right, 1 to 1 gives you 6%. The 4 losers that you have, right, let's say you also risk 1% on each trade. So 6% minus 4% gives you 2% return. So you can see that these two trading strategy, they end up, right, having similar returns. But the biggest difference is the win rate of each system, right? One might have a lower win rate but a better risk to reward ratio, and the other might have a higher win rate with a poorer risk to reward ratio. And there's no best, there's no right or wrong. It really depends on knowing yourself, the trader, what type of trading strategy suits you, and then you find that strategy and you trade it. Okay, so don't go around, Rayner is a trend follower, I follow Rayner. No, don't do that, right? Understand the different type of trading strategies out there. I'm just sharing with you 2 over here, which are pretty much, quite different, but there are more variations to it. So understand the type of trading strategies out there. Understand the type of win rate you expect, the average risk to reward ratio. So once you find something that suits you, then you can go and trade it. Okay, so understand the trading strategies you are trading, because not all of them are created the same. And as a general guideline, right, usually when you have a lower win rate, you have a deeper drawdown and the length of your drawdown is longer compared to a trading system that has a higher win rate. Okay, so with that, right, let's do a quick recap. Right, number 1, you must have an edge in the markets, right? Just like running a fried chicken business, right? You want to focus first is on your edge, not on your risk reward ratio, not on your psychology, not on your trade management, not on your stuff like that. No. Focus on getting an edge. Number 2, you must have realistic expectations in trading. Trading is not a get-rich-quick scheme. In fact, I tell people that trading is a get-rich-slow scheme. Okay? Have realistic expectations. Manage, your expectations, alright? So you don't get disappointed along the way. Man, I didn't make 50% this month. I'm a horrible trader. No, come on, right? Number 3, not all returns are created equal, because as I've shared with you, right, returns without looking at risk is like okay, I can't come up with an analogy, but when you look at returns, always look at the risk required, right, to achieve those returns. And finally, right, not all trading strategies are created equal, right? There are many different type of trading strategies that make money in the long run, but where they might differ is their win rate, the length of their drawdown, and their average risk to reward ratio. So understand them, right, before you trade those strategies that you want to go with. Okay, so these are the 4 things, right, that I hopefully share with you. It's not too late for you. I mean, if you're watching this right now, it's early, okay? And also, okay, if you want to learn more, right, go down to my website, tradingwithrayner.com. Right, this one is not too late as well, still early, right? Tradingwithrayner.com. And I have a couple of trading guides here for you. If you want to learn more about trend following, riding trends, then hey, Ultimate Trend Following Guide is for you. Click this orange button, right, and I'll send it to your email address for free. If you want to learn more about price action trading, market structure, support resistance, then click this one over here, right, and I'll send this Ultimate Guide to Price Action Trading to your email for free. Okay, so with that said, I've come towards the end of this video. If you have enjoyed it, hit the thumbs up button, subscribe to my YouTube channel below, and feedback, questions, comments, let me know below, and I'll do my best to help. With that said, I'll talk to you soon.